Okay, let's unpack this. We are looking into a transformation story so large, it's it's basically warping the entire enterprise tech landscape right now.
It really is. This is the story of a decades-old database leader trying to pivot.
And not just pivot, but to dominate the AI cloud infrastructure space through this, well, this unprecedented multi-billion dollar bet.
Exactly. It's a complex picture. You've got these mammoth financial figures, but also genuine technological innovation.
Our mission today is to cut through that complexity. We want to give you a clear, concise understanding of what this giant strategic gamble is all about.
And a strategic gamble is definitely the right phrase. We are tracking a dramatic metamorphosis here.
Right.
The whole story is about how a company built on this legacy of data management.
The one that basically everyone uses.
The absolute core relational database engine,
Yeah.
used by something like 90% of the Fortune 500. How they're leveraging that power to become a major hyperscaler with AI at its absolute core.
So this is not a small shift.
No, not at all. It's a foundational re-engineering of the entire business. And it's backed by some truly colossal financial commitments we've seen recently.
Okay, so our focus today is on this seismic shift to the cloud and what it means. Not just for enterprise AI, but for its valuation, for rivals like AWS and Azure, and, for the global supply of AI compute.
It all comes down to one massive number, really.
$523 billion. Let's start right there. That immediate jaw-dropping number that, well, it defines the future visibility of this company, the sheer scale of their guaranteed future business.
We're talking about their remaining performance obligations, or RPO.
Which hit an astounding $523 billion in the second fiscal quarter of 2026.
And what's fascinating here is what that RPO number actually is. It's not just a forecast, right?
No, it's contracted revenue.
It's revenue the company is legally contracted to deliver in the future. It's like a builder who's signed contracts for homes that will take years to build.
So it's this massive, visible, guaranteed backlog.
Yes, and that gives the market tremendous confidence in their multi-year revenue stability. It goes far beyond just thinking about the next quarter.
And the growth of that RPO is what really grabbed everyone's attention. It didn't just, hold steady.
No, it increased by $68 billion sequentially.
That's a 15% jump quarter over quarter.
It's a staggering injection of future revenue, and it is clearly directly tied to this AI supercycle.
It has to be.
Oh, absolutely. When you dig into the composition of those contracts, you find the clearest validation of their infrastructure. The huge surge came from mega deals for their cloud infrastructure, OCI.
Specifically for AI training and inference.
That's right. And we know who's driving that demand, which is crucial for proving the quality of the tech, isn't it?
It is. The fact that they're naming names.
They are. Meta and NVIDIA are explicitly named as key customers, signing these multi-billion-dollar AI cloud deals.
So the takeaway here is that they're winning on performance.
Yes. On a very specific, high-performance network topology that you need for massive language model training. AI training needs incredibly low latency, high-speed interconnects across thousands of GPUs. And they've clearly engineered their OCI to meet that high bar.
And that backlog, the RPO, it isn't just a promise for the future. It's translating directly into accelerated performance right now.
Exactly. Let's quantify that. Total revenue growth was 14% year over year in Q2 FY26. That's $16.1 billion.
And that's an acceleration from 12% in the quarter before.
It is solid for a company this size, but the real story is where that growth is coming from.
It's the cloud segment. That grew 34% year over year.
Right, but even within that, if you isolate the real frontier, the cloud infrastructure segment, OCI, that growth was, just staggering.
It rocketed up around 68% year over year in Q2.
That kind of explosive infrastructure growth, you just don't see it from a company that's been a global enterprise fixture for decades. You see it from startups.
So this acceleration, which is all being fueled by AI demand, is why analysts are forecasting total cloud growth of over 40% in FY26.
With OCI itself exceeding 70% growth. This is why the stock has commanded such intense attention.
So that brings us to the next crucial question. In a cloud market that's as well, it's dominated by giants like AWS, Azure, and Google Cloud, who've had a decade-long head start. How is this platform managing this?
How are they attracting the biggest AI players and getting this kind of growth?
Exactly. What is their unique competitive moat?
It's a multi-layered moat, and it's based on recognizing where their true strength lies and then executing a very pragmatic, modern strategy.
Okay, so layer one has to be the foundation.
Database dominance, you mentioned it earlier. They are the #1 relational database used by over 90% of the Fortune 500.
And that's the key point about switching costs, right? For a major bank or an airline moving their core database, I mean, that thing might have decades of complex business logic built in.
It's so risky and expensive that it's often just deemed impossible.
They're locked in,
Right.
and the company knows it.
Precisely. The switching cost is nearly infinite. That provides massive financial stability. But layer 2 is the real surprise. The modern innovation. It's their strategy to the other hyperscalers.
Instead of fighting them head on, they're partnering.
Right. They're embracing this multi-cloud strategy that sounds completely counterintuitive at first.
They're building data centers inside the competition.
Exactly. They are proactively building 72 multi-cloud data centers embedded inside AWS, Azure, and Google Cloud environments.
So they're taking their unique database tech to where the customer already lives.
Instead of forcing a complex, expensive migration, and it's a deep integration, not just renting rack space. We're talking specialized hardware, dedicated low-latency network interconnects. It's complex.
And once a customer adopts something like Oracle database at Google Cloud, they're locked into that partnership.
They are. And we know it's working because the growth data is just astonishing.
What are the numbers there?
The multi-cloud database business is their fastest growing segment. It was up an incredible 817% year over year in Q2 FY26.
Wow.
So that validates the strategy. They're carving out this niche as the flexible, high-performance database layer across the entire cloud universe.
Okay, so that brings us to layer 3, pure AI lock-in.
Right, and this ties directly back to their enterprise roots. They've embedded over 50 AI agents into their Fusion Cloud applications.
The HR, finance, supply chain suites that those Fortune 500 companies already use.
Exactly, and they have plans for over 600 new agents. By delivering automation and predictive analytics right inside the mission-critical apps customers already use, they massively increase that lock-in.
So you don't need a separate third-party AI service. You just use the one built into the ERP you already own.
That's the idea.
Now, here's where it gets really interesting from a supply chain perspective. Chip neutrality.
Right, they sold their stake in Ampere, their in-house chip project.
Why?
Well, it's a move of pure strategic genius in the current AI market. Developing your own silicon is fantastically expensive and risky.
So by exiting, they reduce that financial risk.
Massively. But more critically, it maximizes flexibility. In this fast-moving AI hardware race, being chip neutral means they can buy the absolute best chips available, NVIDIA, AMD, Intel, to meet customer demand instantly.
It basically makes them the world's most flexible broker of high-performance compute.
Yes. They can guarantee customers like Meta and NVIDIA get the precise, latest generation hardware they need. It's a critical advantage when you're signing those multi-billion-dollar AI deals.
So we have a huge growth story, driven by AI, secured by this multi-layered moat. But this kind of scale requires colossal capital, and that represents the biggest paradox for you to consider.
The paradox of fantastic operating margins, but huge upfront investment.
Let's shift to that financial trade-off. Is this scale sustainable? Can they afford this growth?
Let's start with the positive side. Profitability on the existing business is excellent. Net profit margins expanded significantly from 21.2% to 25.3% over the last 12 months.
So you're seeing that operating leverage as the cloud revenue scales up.
Absolutely.
Yeah.
And EPS growth in Q2 was huge, 91% GAAP, 54% non-GAAP. And the market really focuses on that 54% non-GAAP number because it shows the core business is highly profitable and scaling very efficiently.
And that cash generation from the existing high-margin software business is absolutely vital, isn't it?
It has to be, because they are burning an enormous amount of capital on the AI build-out. And that is the core challenge. This is the bear case.
The company is in a massive investment phase.
They've projected capital expenditures of around $50 billion for fiscal year 2026 alone, just to build these AI-optimized data centers.
$50 billion. I mean, to put that in perspective, that's like spending $137 million every single day for a year on new infrastructure.
It's a staggering figure. And analysts are clear that kind of spending is expected to result in 3 years of near-term negative free cash flow.
Meaning the cash spent building new things outstrips the cash coming in from existing operations.
And it comes with a dramatic increase in debt. To fund this, analysts are projecting they'll take on approximately $200 billion in new debt.
On top of their existing debt load.
Yes. They are fundamentally changing their financial risk profile to go after this opportunity.
So let's push back on that for a second.
Hmm.
Isn't taking on $200 billion in debt an immense gamble? What happens if there are execution delays on the $50 billion capex?
Or if a competing technology comes along.
Right. This debt load introduces a serious risk of strategic overreach.
That is the central risk, and analysts absolutely see it. But here's why the market is, for the most part, tolerating it. They view this leveraging as highly strategic.
Because it funds the growth.
It funds a cloud build-out projected to take OCI from around $18 billion in FY26 toward an incredible $144 billion by FY30. The market has such high conviction in the long-term AI returns, especially with that $523 billion RPO, is proof that the debt seems justifiable.
Assuming the execution is flawless.
Assuming the execution is flawless.
So they're front-loading a decade of growth spend into 3 years. It's a massive bet on market share acquisition today over a conservative balance sheet.
That's a perfect way to put it. And we should note, the dividend and buybacks are generally covered by that pre-existing high-margin legacy business. But the overall free cash flow picture is under extreme pressure right now.
Okay, let's talk about the market reaction. Despite these incredible fundamentals, the huge RPO, the 68% OCI growth, the stock has been volatile. We saw a big pullback from its highs recently.
Yeah, analysts cited drawdowns of around 37 to 42% post-Q2 results.
So why the massive swings if the growth story is so strong?
It's mainly two things. One, just general market jitters about AI spending. And two, more specifically, some initial panic over the sheer scale of that capital expenditure announcement. The market sees a $50 billion investment and negative FCF, and, it gets worried.
But institutional investors seem to be treating this volatility as more of a discount than a red flag.
They are. Analysts are interpreting this pullback not as a sign of weakness, but as a dip buying opportunity. They call it a higher low consolidation zone, which basically means long-term investors are stepping in and setting a new, higher floor for the price.
And the institutional money seems to agree with that, doesn't it?
It does. Institutional ownership is extremely high, around 78.6%. You have major firms like BlackRock and Vanguard significantly increasing their positions.
And what about insiders?
We saw insider confidence earlier in the year. The CEO and CFO were noted as buyers of millions of dollars of shares.
So the conviction is reflected in the analyst targets.
Absolutely. They're aggressively bullish, implying 50% or more upside from recent trading levels, all citing that massive AI footprint and the business momentum.
So let's look ahead. What are the catalysts? What should you be watching in the next few months to see if this is all on track?
The main near-term focus will be the Q3 FY26 earnings release, which should be around March 2026.
And what are we looking for there?
Two things. First, continued overall cloud growth above 30%. And second, and this is crucial, further expansion in that RPO figure. Any slowdown in RPO growth will raise immediate red flags.
And beyond the earnings, we need to track the physical build-out.
Absolutely. We need updates on the rollout of those 20 new sovereign and AI cloud regions and concrete progress on those 72 multi-cloud data centers inside their rivals' clouds.
Because those are the physical milestones that actually unlock the revenue from that huge backlog.
Exactly. The execution of the physical build-out is the single biggest operational risk right now. So to summarize the thesis for you, this platform is using its foundational old-world database power to become a new-world AI infrastructure powerhouse. It's funding an explosive growth surge by taking on massive leverage.
So the risk is the execution of that $50 billion capex and managing the debt.
And the reward, if they succeed, is becoming a multi-hundred-billion-dollar cloud enterprise by the end of the decade.
So what does this all mean? The ultimate long-term question for you to consider is this. Given the validated demand shown by that $523 billion RPO backlog, is the current stock volatility simply noise around a massive multi-year transformation?
Or is the near-term debt and free cash flow pressure a sign of strategic overreach that will inhibit their ability to execute and ultimately limit the return?
Something for you to mull over as you track the next few earnings reports and that crucial RPO figure.